All right, everyone. As always, welcome to another installment of Coffee with Carl. Today I have Jeremiah and Matthew from Rowe Price. I'm going to go ahead and turn it over to Jeremiah real quick, just give him opportunity to quickly introduce himself, as well as Matt and the firm. Thanks, Jeremiah.
Perfect. Thank you so much, Carl. Hello, everyone. Thank you for joining us today. Again, my name is Jeremiah McCullough, internal sales consultant here at T. Rowe Price, covering the Mid-Atlantic territory and supporting retirement plan investments. So joining me today is Matt Coe, CFA holder and equity strategist here at T. Rowe Price. In his role, Matt helps connect our market insights and portfolio perspectives with the needs of our clients while communicating our capital market outlook, asset allocation views, and investment strategy insights. Prior to his current role, Matt served as a vice president and portfolio specialist in the multi-asset division, where he served as a proxy portfolio manager for over 30 billion in global multi-asset and alternative investment strategies. And also before joining T. Rowe Price in 2017, he was a investment director at Putnam Investments. Today, Matt will share our mid-year market outlook and T. Rowe Price's perspective on where we see opportunities in the current market environment, and we'll also leave time for you guys at the end for Q&A. Matt, again, thank you for being with us today, and I'll turn it over to you.
All right, thanks for the intro. Can everyone hear me? Jeremiah, give me a thumbs up if I'm coming on. All right, sounds good. All right, so to start, if we're looking at the current market environment, this is an environment where if you're just looking at the headline number, just looking at the total return on S&P 500, it doesn't tell the whole story. Because if you look at the index, right, it's up about 8% through the year, and that means it's pretty close to its all-time high. So the markets have held up pretty well, even though we still have concerns around Iran and what's going on in the Middle East. And obviously, the Strait of Hormuz is still, acting like a bottleneck on global supply chains. But stocks have been resilient, and why that is, well, mostly because corporate profitability has been really, really solid. If we're looking at the trends that are really driving that, AI spending just continues to be a major driver for not just corporate earnings, but also the U.S. economy in aggregate. And because the economy is growing and stocks are making more, or companies are making more money, right? The overall market has been pretty resilient. So if you look outside, right, and you're kind of at a distance, you'd say, there's not too much to worry about. But if you zoom in a little bit closer, there's a lot going on underneath the surface, right? So as an investor, I wouldn't take the current market resiliency as some sort of sign of stability. There's too many competing forces right now. Like just to list a few, right? I'm thinking about geopolitical concerns are still an issue. Inflation trends are now picking up. AI investment spending, while it has been a sort of a driving positive force for much of the economy and corporate earnings, it's also starting to become a disruptive force. We also have the Federal Reserve starting to change their tune around interest rates. That at one point they're talking about cutting interest rates, which would be beneficial for the economy. Now they're talking about starting to potentially hike interest rates. So what I would pose is that with all these sort of undertones of the economy and the markets having a lot of sort of counter currents, you might be in an environment where there's going to be a little more volatility, and market leadership may start to change. So the big message I want to leave with you, right, or I guess where I'll start this presentation is that the overall opportunity set for investors is starting to get broader, but the market is also becoming a lot more complicated. Now, a broader opportunity set is a positive in the sense that it means that all of us as investors have just more ways to win, right? There's more things you can own that could actually work out. But it also means selectivity matters more. It means that diversification matters more. And simply just owning what's always worked in the last several years, the last decade, that may not be enough, right? The playbook is starting to change. Now, T. Rowe Price, highlights five major shifts that are changing and shaping the market today. Jeremiah is sharing a screen here or a slide here that sort of outlines all five. Now, these five, themes, I was asked to talk about for the next 10 to 15 minutes. But they're a little bit complex to unpack. So instead of trying to speed through or do a speed run through all five themes, what I attempted to do was summarize maybe three key takeaways that sort of underpin all the five major themes. So for some of you who like to take notes, I would write down maybe three main ideas. One, global risks are starting to rise a little bit more, and uncertainty is a little bit higher. Number two, inflationary forces are starting to emerge. And Number three, diversification is going to start to matter again. So let's take a quick step back, right? For a long time, investors, they're used to a certain type of market environment. Inflation was low, interest rates were low, globalization was a tailwind, and what that meant was supply chains were really, really built for efficiency's sake. So that environment essentially rewarded investors who owned the benchmark, owned large growth companies, and just didn't overthink the macro environment, right? There's no real reason to do that. But that playbook may be changing on a going forward basis. This is a market that's going to start to ask all of us to do more, right? Pay attention to the macro risks again. Going to ask us to look beyond just the obvious winners. And we might have to start to think a little bit more about, what kind of regional exposures do we want? What kind of sector exposures do we want? What kind of asset classes are going to be beneficial? So to start this presentation, let's go to the first summary theme, right, that I identified, right? Sort of global risks are going up, or uncertainty is going up. So for decades, companies built, global supply chains really around efficiency. It was all about make goods where it's cheapest and just ship it to wherever it needs to go. But companies today, they're starting to ask a whole different set of questions. They're starting to, ask things like, is the supplier reliable? What happens in the next crisis? Is the supply chain secure, right? So this doesn't mean that globalization's over, right? We're still going to have goods, services, technology, capital, going across borders. But the entire system is becoming that much more complicated because security matters more, resiliency matters more, and ultimately what results is redundancy. And in investing, when you're starting to factor in all these sort of concerns on security and uncertainty, what that means is that the risk premium goes up. Now, if you don't know what the risk premium is, think about it quite simply as it's just the extra return an investor is going to want to justify stepping into, right, that environment of uncertainty or heightened uncertainty. So it's just more compensation for taking on additional risk. Now, the takeaway here, I just talked about sort of, maybe a little bit of a global fragmentation here, and some of the uncertainty underlying that and some of the risks involved. The takeaway isn't sell your international stocks because of uncertainty and just own U.S. companies, right? That's not what the takeaway is supposed to be. The takeaway is we have to be that much more selective around what types of international holdings we have. What types of companies can actually withstand maybe deglobalization. So the next theme I want to highlight is around inflationary pressures starting to build again. Now, there's two main reasons why inflationary pressures are starting to build. And it's going to be, I think, the decade ahead, the overall inflation on average is going to be higher than certainly what we experienced in 2010. So for those of you on the call who, who are, looking to buy a house and you're saying, hey, I want to buy, a house with a 3% mortgage, I don't think that's going to happen. But for the savers, right, the disciplined savers, you're going to get a little more risk-free income. Now, why inflation is starting to go up? Two factors. Well, number one, there's a global revival in manufacturing activity. And I'm going to unpack that a little bit. And number two, AI, right? AI requires a tremendous amount of physical infrastructure to support it. So earlier I discussed how countries, right, companies, they're all looking to focus on resiliency and security around the supply chains. Now, what this means is that we're going to ultimately have a duplication of efforts. So production is going to become a little more local and regional, as well as, you're still going to source from low-cost producers globally. But it's all about more the focus on reliability versus, is this the cheapest cost, right? Mm-hmm. And by bringing on extra manufacturing or building extra manufacturing capacity, that costs money, right? Creating backup supply chains, that costs money. Moving production closer to home, that can be a little more expensive. So ultimately, moving away from the global low-cost supplier to more of a focus on security, it results in just greater inflationary pressures, or at least, the very least, right, inflation volatility starts to pick up. Now, later on to that, when I talked about AI, we've got this massive increase in spending on data centers, because data centers are at the heart of artificial intelligence. Now, building out a data center requires a tremendous amount of natural resources, right? You need more copper, right? Aluminum, steel, cement, right? You need the transportation of all those materials. Data centers also require a tremendous amount of power, right, and reliable power to provide, sort of ongoing electricity. And so what this means is that the demand for natural resources beyond just oil and gas, maybe critical rare earth minerals, is going to start to increase. Now, to be clear, right? Like, this isn't another sort of sign or a call for a takeaway that, hey, the guy at T. Rowe Price is talking about inflation and talking about how we need more natural resources because of, manufacturing surge and AI. It's not a call to go out and get more commodity exposures in your portfolio, right? And why that is, well, commodities, can be great investments, but they also tend to be, very, very volatile investments. And so I would, not draw the clear conclusion that it's automatically, right, just, load up on commodities and commodities is a trade for the next decade. What it does mean, though, is that ultimately, if inflation starts to come back up and inflation pressures start to build again, what you're going to have is the interest rate environment is going to be a little more volatile. And that's going to matter a lot, especially as it relates to your fixed income portfolios or your bond holdings. Because when inflation's stable and interest rates are, pretty sort of subdued, right, predictable, investing in bonds is almost like going on autopilot. You just sort of buy and hold the maturity. You really don't have to think about it too much. But when you're starting to have inflation act a little more volatile, the bond market becomes a lot more tricky. You start to have to make decisions around how much interest rate sensitivity you want. And you might want to start to think about, other areas within the fixed income markets, within the yield curve that may be opportunities. So bonds still matter, right? You still want to have it, and having bond exposure is important. But what type of bond exposure matters more than just having bonds within your portfolio. So I think about it more from a standpoint of like, yes, have the allocation, but you have to think a little bit harder around what types of allocations you want to have within fixed income. So the last summary theme, diversification matters again, right? We had this environment where the last several years, it was a hyper concentrated, sort of market led by just a handful of large tech companies, right? And why that is, well, AI has been one of the driving forces of that. And, as artificial intelligence started to develop, markets quickly rewarded who they thought were the reliable, sort of the known winners, right? Those were like the semiconductor companies, the big infrastructure providers. And that made sense, right? Because we're still, somewhat in the early stages of this new technology cycle, and the obvious winners are going to get rewarded. But what we're starting to see is that the AI story is starting to broaden a little bit more, right? That concentrated technology play is now becoming more of a industrial and infrastructure play. So the AI cycle is starting to go from not just all about the models and the software, it's going into more about the entire ecosystem that surrounds AI. So yes, you still need, right, high-powered chips, you still need GPUs, you need data centers, but you also need power, you need cooling, you need networking equipment, you need cybersecurity, right? You need all the physical infrastructure that goes into sort of building out, right, AI infrastructure. So if you think about the first phase of AI as just being, here are the leaders and the known winners, right? The next phase is going to be about the build-up, the companies that are providing infrastructure, power, right, equipment, right, connectivity. Those are the things that are going to start to win. So if we think about AI and sort of, what's been shaping a lot of our portfolios, whether you're doing it directly or indirectly, what happens is that the markets start to assume that, only those AI investments that are the most obvious companies that are being well rewarded right now is the best strategy. But that's actually a little bit of a risk, right? Because, some of these companies, while they're great, the investment prices are starting to reflect perfection, right? They're starting to reflect that this AI trend will never slow and that more people will continue to buy chips, right? And will continue to support some of these big tech platform companies without any competitive threats. The questions we're starting to ask is, well, where's the real demand? What companies can harness AI technology and create durable earnings growth and cash flow growth, right? Where are the margins going to improve and where's productivity gains being had? And more importantly, what about those parts of the markets that are underestimating the impact from AI? So this is where active management, active research starts to matter again. Because if I look across our research platform and I ask, right, like, who are going to be some of these AI winners? It's a diverse mix of businesses. It's technology companies that are going to harness AI for self-driving. It's also going to be healthcare companies that are going to be at the forefront of drug discovery and research. Financials companies that are going to do a better job of underwriting credit and insurance, right? Even media companies that can make content at a cheaper net cost. So what may occur is that as AI goes from sort of test pilot use case into more of the enterprise level and more of greater adoption across society, we're going to have a more dispersed market where we're going to have real winners and losers, and the gap and the returns of those winners or losers can be much wider than what we had saw in this sort of concentrated market where just a handful of companies won. So to make this a little bit more practical from an investment standpoint, right? Think about small and mid-cap stocks. They've lagged considerably over the last decade, although they're starting to do a little bit better more recently. If the market starts to broaden away from these mega cap tech companies, right? These small and mid-cap companies have a lot more room to run and can have greater sort of return potential. But keep in mind, historically, they've also been more volatile. Similarly, if we think about sort of value-oriented strategies, they've lagged for the greater part of the last decade. But once investors start paying attention to maybe starting valuations and improving fundamentals, right? They may start to reward more value-oriented strategies again. And also keep in mind that value strategies today, they tend to have a little more of that energy and natural resources exposure that I had mentioned earlier. That can be an opportunity. But value investing also requires a lot of patience. It's not something that's going to be rewarded overnight. So
Do you have when you mentioned the small mid cap, do you have, while there could be opportunity sets there, do you have concerns just if they end up having a rising interest rate environment, ultimately the traditional effects of higher interest rates on those sectors?
yeah, so higher interest rates have historically some correlation to how it impacts small cap stocks. And you can sort of think about it as if there's higher inflation, higher interest rates, cost of financing goes up, smaller companies tend to borrow more, so they could be more negatively impacted. So that's like the maybe the sort of the simple sort of story as to maybe a signpost to look for as to small and mid cap companies might be challenged in certain types of environments. But if we sort of zoom out the lens, right, I can look back to the 1970s. That was an environment of high inflation, high interest rates, and small cap stocks actually did extremely well. So I don't think it's as simple as saying its interest rates are higher, inflation's higher. I think those matter because it kind of helps tell you which way the wind is blowing. But ultimately, what matters is going to be earnings, right? Like investors care about earnings. And if we're starting to see, we get to the point where, yes, earnings are starting to accelerate for small mid-cap companies. I don't think, a 25 basis point hike in interest rates or, two hikes, right, is going to be the callus that's going to somehow derail that sort of earnings trajectory. And we're starting to see that actually right now, right, in the current environment where small mid-cap companies are expected to, at least, expected to. Right? The data is still undetermined. Well, the actual data says, things are okay, but it's expected to actually increase more so in the coming several quarters where small and mid-cap companies' earnings growth is going to be considerably higher than large cap companies.
You mentioned another theme just around kind of the initial winners. A lot of these big semiconductor, the hyperscalers. I get questions. I had one this week from an employee wanting to do self-directed, and they're like, I want to invest in VGT, which is just obviously information technology index, and then it was the SMH was a semiconductor index. And you see these big trends, and everyone's seeing these indexes up 100%, and then they want to load more into it. It seems your takeaway is those areas could be, of the most concern.
Yeah.
And I guess maybe if you could elaborate there and just how that may affect the S&P given the large allocation to some of those names.
Yeah. So, you mentioned some of the tickers that comes up in sort of some client conversations I've been part of, as well as sometimes people say, I don't know what's going to happen, Matt. I'm just going to buy the Qs. And, and the challenge I have with that sort of approach is that, it it can work when that sort of momentum and signal is very, very strong and the wind is blowing, right? The wind's at your back. But when you get to the point where there's more of like a shifting, right? Maybe a potential changing of the guard and some concerns around, is this cycle going to be durable enough, right? You're going to have greater dispersion between the winners and losers. So think about just semis, right? NVIDIA is sort of at the forefront of AI technology and linchpin technology. It's probably always going to be around. It's always going to be relevant. But the question is like, are they going to continue to sell the same level of GPUs, or is the pattern going to start to slow? Right now, the focus has been like, sell NVIDIA, let's go buy, or the market narrative has been sell NVIDIA, let's go buy, some of these memory companies, right?
Yeah.
Because the critical supply chain bottlenecking in memory. The problem with memory companies is that they're hyper cyclical businesses, and they're businesses that over long periods of time tend to sort of kind of almost go around in circles, right? Meaning like it starts at one level, it goes high because the profitability is high and pricing is high, and eventually oversupply floods the market, and the pricing goes back down, and these stocks end up no better than what he started, right? So
Yeah.
it tends to be something that if you're holding it for long periods of time, you'd say, right, how much exposure do I want to have? But the market is so hyper focused on the here and now, they're losing sight of the fact that these are businesses that tend to be prone to boom and bust cycles. So
Yeah.
you're going to time it just right. Yeah, you could get some of the last so bits of that semiconductor trade, but if you're to sit there and hold on to it and double down, saying I'm just going to own this for a while, well, that cycle might come against you at some point, and you might be sort of subject to some serious losses. We're actually seeing it in the marketplace today, right? There's actually a couple, yesterday and today, you're starting to see some of the high flying semi names and tech names starting to come back and get a little bit of gravity. I don't want the takeaway to be, T. Rowe's negative on some memory companies. Actually, we have a favorable view on them. But the behavior to say, I am going to sell a lot of my portfolio and I'm just going to load up on just one narrow part of the market, that's what I would sort of push back against and saying, now's the time to actually doing the opposite, start thinking about more of a diversified portfolio, more of a diversified exposure, and maybe owning some of those things that haven't worked as well, but are still tied into the broader AI theme or sort of broader sort of deglobalization theme.
I mean, I think this really hits on your thought process and T. Rowe's strategy in general of stock picking. I mean, one of the biggest challenges is just everyone does indexing now.
Yeah.
Um, and then you have that over concentration. So, if you were to see a pullback in some of these names, I mean, how are you guys thinking about the market? Not necessarily, this year, but maybe over the next 2 to 3. I mean, are you guys concerned about just general markets like S&P, indicators just lagging or being, or just lacking the overall growth we've seen just because of the exposure to, potentially some of these names?
Yeah, I think we've got 10 names in the S&P that make up about 40% of the index. You have at some point you got these hot IPOs like a SpaceX and Anthropic, right? Some of these big AI companies, they'll eventually be part of the index as well. So I've seen some estimates that the top 10 names in S&P could make up half the index. So if you think about that, right? By owning the index, technically you own hundreds of stocks, but really, right, your returns are, really reliant on just a handful of stocks. And if that theme is still there and the market's rewarding those sort of obvious winners, then you can do well. But if the market starts to discern, sort of the winners and losers, right? You're going to be getting a less than sort of desired, right? Maybe some of this underappreciated risk by just going passive and just owning the index, right? And the market's starting to do that right now. You look at this most recent earnings season, you have, in aggregate technology companies did well, the market's up, but they're starting to penalize companies like a Microsoft and Meta saying, you're tied to AI, but you have to spend a tremendous amount of money to keep up or to have some sort of valuable service offering. So I think the market is no longer just trading it as a basket and saying we're going to reward all winners. They're starting to pick and choose which specific winners they want to have exposure for, or which specific companies are going to be the winners and which specific companies are going to be the losers. And so again, this goes back to sort of the thinking that you want to have either greater diversification because you don't necessarily, there's more uncertainty, you don't know where the market's headed. Selectivity matters, right? Because you're just going to get into an environment where you're going to have much more dispersion of returns, right? It's no longer the basket trade, buy the ETF and get all of it, right? It's going to be much more selective in terms of which specific companies are going to win, which specific companies have more of a durable sort of growth profile and a wider moat around those businesses. So I think that's what the market is starting to start to show some signs of, and on a go forward basis, that's how we believe, right, the market's is going to react. Is that it's going to be a lot more of a less of a concentration, more of a broadening, and selectivity is going to matter that much more.
Maybe, and I know you started to go through this. What areas would you highlight as the biggest opportunities, within that broadening out process?
Yeah, so within the broadening out process, from like a sector allocation, you know, natural resources, like we like healthcare is another sector that we like as areas that can benefit from harnessing AI, or sort of tied into the AI theme, but in a non-direct manner, meaning sort of energy and natural resources, right? It's not like they're selling computer chips, right? But they do benefit from the broader trend around AI. So those are the areas I would say from a sector allocation that we tend to like. Also within equities, from a regional standpoint, we like emerging markets a little more so. They tie into the commodities trade, but also emerging markets do have some technology exposure, whether it's related to creating the chips or memory chips, or sort of optical cable wires that go into more of the infrastructure around all things AI. So we're playing some of the lateral plays versus just playing the direct ones like the big tech companies.
You mentioned emerging markets. Yeah, how are you guys thinking about some of the, potential geopolitical issues? Um, who knows what happens with, kind of China, and then just the different relationships we have with some of these other countries. How are you guys trying to or how are you guys navigating, some of those different conflicts we're dealing with right now?
Yeah, so I think for risks regarding so let's say Taiwan and China, like, we don't have an edge. We're not going to be able to predict that. It's more about maybe a form of risk management, saying that we want to have exposures right now. We also do know that if something were to happen between China and Taiwan, we'd have to be much more quicker to adjusting our positioning around that. So it's not about avoid it now because some potential threat may happen. It's more about maybe owning the names, but being that much more sort of quicker to change, right, our opinion should something happen in the future. So I think as it relates to anything outside the United States, most investors are going to take maybe an overly conservative view, saying right, too many geopolitical concerns. That means I'd rather just put everything in the U.S. and maybe not own so much internationally. Um, I think this is a time that if you're going to own international equities, it's not about again going out and buying right the ACWI ex US, right, like the ETF, and saying I want all things international. What you would rather have is maybe use sort of a select global equity strategy, like looking for like global leaders, maybe looking at an actively managed international equity strategy, whether it's in developed markets or emerging markets. Allowing research, right, being a filtering lens to sort of pick and choose who those winners and losers are, versus just taking a broad-based approach. I feel like I'm sort of repeating myself a little bit in terms of this presentation, but I think we're coming into an environment where you know that selectivity matters more, right? And what we're going to have is just an environment where you're going to have much more sort of competing factors, that you can't just own the entire basket anymore, right? You're going to have a more fragmented world. You're going to have more capital intensive world. You're going to have more of an inflation sensitive world, right? AI is still going to drive the markets, but it's also going to be a disruptive force as well as sort of a beneficial one. You're going to have a much more energy aware, right? So this is something where, again, if you're just owning the index and the index is highly concentrated, that's not the type of exposures we'd be sort of advocating for at this part of the cycle.
Yeah, I come across all the time where I see folks just putting their money in the S&P 500 or the QQQs. And again, it's worked really well over the last, 5, 6+ years. But now you're starting to see that disparity when you actually look at some of the international performance, and, you zoom out and you start to realize over the last like 2, 3 years, it's, outperforming, right? So I think that, those trends, obviously, it seems like you guys are certainly leaning into that, as we move forward.
Yeah, that's exactly right. I remember when I started my career, I've been in this industry 25 years ago. It was all about diversification and how you want to be, have a diversified portfolio. That's still a message that I think the industry still adheres to. But if I look at sort of just investor behavior, it's very concentrated. It's all about, I just want large tech, and that's all I want.
Yeah.
And what we see is mean reversion tends to be a strong factor in the markets. When you're over earning, right? When you're getting too much of a return in one particular part of the market, what you tend to have in ensuing years is sort of lesser returns, right? all things sort of average out to the middle again. And so if you're owning large tech companies and done extremely well, I don't want this to be like today's the day where this is the peak, right? Like tech companies can't make any more money. It's not that. It's just that a lot of that has done so well. It's priced for perfection or near perfection. So if you don't get the follow through, you're going to get a lot of sort of negative results or maybe just kind of meager results. And there's a lot of other parts of the markets that have been underappreciated that can still benefit from, whether it's AI or the race for security around supply chains or sort of the need for more natural resources, right? Those are all areas that in the future, right, they could end up being like the next tech trade, right? I wouldn't be at all surprised if we had this call several years from now and you're telling me that it's not the QQQ, man. Everyone's loading up on this energy ETF, to this
Yeah,
commodity ETF, and I'm really worried, right? And that could happen, right? But that's the environment that I see on a go forward basis is that we need to be a little more diversified in our holdings, not just loading up on what's worked in the last several years.
I appreciate that. Yeah. I think the challenge again, right, is just momentum. Folks see the momentum and, they continue to pile in. And, when you don't see any sort of big correction, you feel like it always works, right? As we finish up, if anyone wants to send any questions in for Matt, please feel free. And along that same trend, is there anything that you guys are, or at least starting to be concerned with, as far as underpinnings that could lead to maybe that bigger correction? I mean, I get the consensus. Most folks are, calling for more volatility, over the coming months. Is there anything that you guys are looking at saying, okay, this could be, lead to something much bigger? And whether that's, a couple years down the road with elections and how those things could change. Is there anything that you guys are keying in on as maybe more of a long-term trend you guys are just watching for?
So there isn't anything I think on the horizon right now that would spook us to say, we're really worried about a significant drawdown. Can we have more of a kind of the run-of-the-mill 5-10% correction, which kind of happens sort of intra-year? Yes, absolutely. And sometimes those have very little to do with anything in terms of fundamental, but sometimes maybe just market narrative shifting temporarily. The bigger concerns around sort of bigger drawdowns, let's say it's like 20-25% or more, those tend to be associated with recessions. And if we're looking at economic data, manufacturing data, services data, right, labor markets, everything's really, really healthy. And so the chance or the probability of a recession here in the United States, at least for the next 12 months, is extremely low. Not well, I wouldn't say extremely low, but it's below average and it's on the lower side. So I would say there doesn't seem to be too much reason for concern of a significant market pullback. Now that said, right, if I say that the economy is doing well and the overall markets don't have a high chance of a big pullback, that doesn't mean that certain semi ETFs won't have right an environment of a big pullback. All right, you can be in an environment certainly where a narrower slice of the markets right can have a bigger pullback, and that's largely due to maybe shifting narratives but also the starting point being extreme valuations. Right, your starting point is having very very high valuations in just certain parts of the markets or certain stocks. Right, it doesn't take much for a shifting of the winds, right, for those stocks to then start to come down considerably. Look at some of these Korean memory stocks like a SK Hynix or a Samsung, right? They were like the darlings of the year. Like these stocks were up multiple fold. And just in the last couple of days, right, you're seeing those stocks falter considerably. So if you were to time it right, and got out, a week or so ago, you'd be very happy. But if you're sort of piling in and continue to pile in, looking to add more, you'd have a lot of losses on your hands in a very short period of time. So I think that's where we see the risks is that there are some parts of the market that valuations have gotten a little bit out of hand. The positivity, the momentum, the sentiment is just extremely bullish. And so if you don't have the follow through, if you don't have just everything lined to perfection, you could have some losses and less than desired results.
Yeah, that reminds me of like software, right? I mean, we've seen, over the last few years, the CRM, CRM and all the other
Yeah.
companies kind of associated. I mean, 5, 6 years ago, we're just blowing through the roof. And then to your point, the market just left them behind, right? And now we have the AI trend basically says we don't even know what's going to happen with software companies acting like there's no chance that they can't reemerge and produce cash flows in 5, 6 years. So their values are basically nothing and they may go bankrupt. But the stock market hasn't really, flinched. And obviously that's a big part. So I think that really, should have folks thinking about just that conversation around these semiconductor names that are up 2, 3, 4, 500%, that, there could come a time if memory or, some of these GPUs, data, et cetera, become a little bit cheaper and you could be more efficient and you have other options. And if that does happen, it certainly could take a hit in those areas. So I think, as we sum this up, Matt hit the nail on the head here. Diversification is going to be key. You want to, one, really look through and make sure you're not over concentrated. I've seen that time and time again, with folks because they don't want to let go of some of these winners. And then when you actually look at it, they own NVIDIA, but then they own a fund that has 10% in NVIDIA. So you're not really just 10% in NVIDIA. So I think, and especially too, if you're in the S&P where it's such a large aggregation of these big tech names. So I would certainly recommend folks, really use this opportunity to take a step back and say, hey, we made some money this year already. And do a review of what their asset allocation looks like and, what the names are underneath the hood if they're using index or using funds. So that way they can go out there and better diversify. Certainly firms like T. Rowe Price, specialize in that stock picking. And I think, them among others that use that specialization will probably reign true over the next couple of years, compared with your kind of set and forget it indexing strategy. So with that, we're over 30 minutes here. So Matt, thank you. This is super informative. Thank everyone for joining this other installment. We'll go ahead and get this up in the coming weeks. If anyone has any questions for myself or Matt, feel free to use my team. We're glad to be a resource, as well as Jeremiah. So we have excellent education and team support for any of you guys that need help. So once again, thanks for joining for this Coffee with Carl and look forward to seeing everyone soon. Thanks, gentlemen.
Thank you. Thank you.
Take care, guys.